On the show today, Nigeria inflation slows to 12-month low. Volkswagen and Nissan to get tax breaks for plants in Ghana. Plus, Zimbabwe plans to end 20-year standoff with creditors. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. We'll get the show started now with the markets, and it's looking like another day of losses at the major African stock markets. We track at intraday, starting from here in Nigeria, where the all-share index has lost over 0.5% as at midday. It's the same story in South Africa, where the JSE index also appears to be sustaining the bearish run, this time with a 0.19% decline at intraday. Meanwhile, the six-member FTSE JSE Africa Banks Index fell 0.7% at about midday in Johannesburg today, following President Ramaphosa's signing of the National Credit Amendment Bill into law, setting the groundwork for over-indebted consumers to have payments suspended in part or full for as many as 24 months, or even scrapped if their financial situation has been found to have worsened. All right, let's look at Egypt there. The index, of course, closed 1.7% lower on Thursday, ending its four-day winning streak. The index particularly jumped in the previous two sessions, news that the country's headline inflation rate fell to its lowest in nearly 4 years. And in Kenya, that index, the Nairobi index, closed positive on Thursday with 0.75% gain. And the markets in the Middle East are closed for the week, but most of them closed lower on Thursday as disappointing economic signals from China and Europe, coupled with an inverted U.S. bond yield curve, stoked fears that the global economy was hurting towards recession. The Abu Dhabi index was flat as 1.1% gain in market heavyweight First Abu Dhabi Bank offset losses in real estate sector. In Dubai, the index was down 1.31%, led by real estate stocks. The Emirates blue chip developer Emma Properties shared 1.9%, while Damac Properties fell 3.2%. In Qatar, the index dropped as much as 2.4%, but it clawed back some losses to close 0.6% lower after the central bank said Qatar's economic growth would accelerate over the next 2 years amid expectations of stable oil prices and continuous strong exports. Saudi Arabia remains closed for the week-long Eid holiday. And in Europe, markets moved higher in the morning as investors monitor Treasury yields for clues on a possible recession. Meanwhile, the trading day in Europe started with a glitch this morning as technical problems at the London Stock Exchange caused a huge delay for the start of trading. Well, Conrad Bussen will tell us how that played out in the European market. Hello, Conrad. Good to see you.
Good afternoon, Chimmy. Thanks for having me back on Channels TV.
Good afternoon, Conrad. Well, reliability is the most important asset for a market operator, especially in uncertain times like this. How much of a damage is this to the European market?
Well, we have to see. It's really a huge glitch that happened this morning at the London Stock Exchange. For more than 1 hour and a half, it was impossible to do any trading over the platforms of the London Stock Exchange. And I have to say, of course, stories like this, at least from the European continent, are all seen in light of Brexit. We should keep in mind, this glitch at the London Stock Exchange is not the only negative story in terms of systems outages from the United Kingdom this month. Last week, thousands of passengers of British Airways were stranded because of a systems outage at the airline company. Also last week, we saw a huge power outage of the national grids network. Now, of course, many people, given, the uncertain political situation in London, the uncertain constitutional situation in London, all this combined makes many people here on the European continent wonder, are the Brits really able to handle Brexit and especially the time after Brexit? And I have to say, there is not much Schadenfreude involved in this, reckoning. People here would rather see the United Kingdom to function well, given the uncertain worldwide and global situation. This week we saw, the markets in Argentina plunge. We saw the unrest in Hong Kong, negative news coming about the US-China trade tensions. In light of all this, stability is something that people on the financial markets here in Europe are yearning for. So, of course, the glitch at the London Stock Exchange this morning is a negative symbol to all of us.
Well, thank good thing the technical glitch was resolved in just a short while. Anyway, the German stock index DAX has lost more than 7% in only 3 weeks. But this week, the decline seems to have slowed down. Any signs on the horizon to be optimistic about? What can we expect for next week?
Well, yes, there are, as always, when you talk to me, there's always hope in the room. And not only because I'm standing here, but because there's actually a lot of data that we can expect next week that might push the market upwards a little bit after the German DAX, has lost around about 7% in 3 weeks. After this week, it was reported that Germany's economy during the second quarter has contracted. And after many companies have come out with their second quarter earnings report, lots of negative outlooks there is now a lot of hope on the trading floors that we're done with the negative news, and that next week's data, among the data, there will be a lot of purchasing managers indices, early indicators from Japan, Germany, France, the United States. This data will contain something positive and something that drives the market upwards a little bit. Today, you mentioned it, the trading here in European trading started on a positive note. And as you can see right behind me, the German DAX is up on this very last trading day of this week. So this might be perceived as a little bit of an indicator that next week will bring a bit of a relief after all those losses.
All right, just before I let you go, let's look at some of the effects of China-U.S. trade. China is now trade war, sorry. China, of course, is now America's biggest creditor. Is not America's biggest creditor anymore. Of course, the latest data from the U.S. Treasury shows that Japan is holding more of the United States sovereign debt, that China clearly a sign that the trade war has an effect on China-U.S. financial relations. Isn't that so?
Yes, Jimmy, you're right. Two things are worth really keeping in mind when we address this topic, that Japan is now a bigger creditor of the United States than China. Number one is, of course, Japan also is taking part in this worldwide race for financial returns. And if you are in Japan, looking at Japanese sovereign debt or looking here in Western Europe for returns on sovereign debt is not very successful. We have negative yields on the government bonds in both Japan as well as here in Germany, for example. Today it was reported that the average yield on German government bonds fell to a new negative low of minus 0.7%. Now, where are you looking? If you look for safe returns, American Treasury bonds, which are still carrying some interest payment when you buy them now, this is where you go. So this is one thing that has to be kept in mind here. The second one is, of course, you mentioned the China-American trade war. I talked to bond traders here and asked them whether there is some political agenda behind this receding of China from American Treasury investments. And the bond traders I talked to said no. The mere fact that the trade volume between China and the US has declined over the last few months means that China needs less hedging of trade deals. It needs to buy less American government bonds. It is handling its currency exposure perfectly in line with the idea to keep its currency stable. So far, the Chinese have not used their treasury purchases as leverage in, the trade spat with America. They're not retaliating here against the policies, put upon them by the Trump administration.
All right, Conrad, it's interesting to end the business week with you, and I'm looking forward to talking to you next week. Enjoy the rest of the weekend. In the meantime, London trading has restarted and the indices opened higher. Now, the London Stock Exchange said it was investigating a potential trading services issue. Let's get a sense of how the FTSE is doing after late opening. Let's talk to Simon. Hello, Simon. Good afternoon. Now, the FTSE 100 and 250 did not start trading straight away at 8 a.m. today. However, the index opened high. It's intraday already. How is the FTSE behaving? And of course, brings up to speed with the currencies market.
Yeah, sure. Well, let's just quickly recap on what happened this morning, because it is quite unusual. Trading in the biggest shares listed on the London Stock Exchange was delayed for more than an hour, in the longest outage in more than 8 years. The reason the London Stock Exchange said, as you just said, it was investigating potential trading services issues, basically a technical glitch. Shares in the FTSE 100 and FTSE 250 indices were affected, although smaller stocks traded as normal at 8 o'clock. Trading resumed at 9:40, the longest closure since February 2011, when it was shut for more than 4 hours. The FTSE 100, which had fallen to a 6-month low, remember, just yesterday, well, it opened 56 points higher when the market eventually reopened, and they were all up on the intraday point earlier. The FTSE all-share was up by over 0.5%, the FTSE 100 up even more at 7,112, and the FTSE 250 up by about 1/3%. Turning to sterling and the pound, not doing too badly either, which makes a change, really. The pound is up on the dollar by over 0.5%, also up on the euro by nearly 1%, and also up by just about the same amount on the Japanese yen.
All right, an interesting data from bank customers today have provided a ray of sunshine for Metro Bank as the embattled business topped officials' satisfaction ratings, while RBS remains at the bottom. What caught customers' interest in Metro Bank?
Yeah, so since August 2018, that's really just a year ago, the Competition and Markets Authority has required banks to publish information on how likely people would be to recommend them, as well as their online and mobile banking branch and overdraft services, to friends and relatives, and they have to update this information every 6 months. Since then, Metro Bank and a bank called First Direct have been tussling for the top spot. First Direct won the first official poll, but was beaten by Metro Bank in the second league table in February. Now the two banks are sharing the crown, with 82% of customers for each saying they'd recommend it to friends and family. It's the opening hours which really set Metro Bank apart from the rest. They're often open late at night instead of closing at 5 p.m. like most high street banks here, and they're also open on weekends. They also pride themselves on being able to open current accounts really fast for their customers and without too much paperwork. So speed and simplicity and convenience are really at the heart of what they do. Metro Bank Chief Executive Craig Donaldson said, "We are extremely proud to still hold the top spot for personal current account service. Service and convenience are at the heart of everything we do, and we're thrilled that the customers can see this. Thank you to all our customers and colleagues for being part of the banking revolution." So yeah, basically convenience, really the watchword there, and that's why I think they've won twice now.
That's quite interesting and encouraging for the bank. Anyway, lead us into next week. What is your outlook?
Yeah, well, two really big stories to watch out for next week. All eyes will be on British Steel after news today that Turkey's military pension fund has reached a deal to buy it out of insolvency. Remember, it went into insolvency in May. Well, the Turkish Armed Forces Assistance Fund, known as OYAK, says it plans to take over British Steel, which employs around 5,000 people by the end of the year. Close to 4,000 jobs are at risk after the firm was put into compulsory liquidation in May, and there are another 20,000 or so jobs in the supply chain. So next week will be a big one for British Steel, and whether this deal does go through, in fact. Lots of people also watching news from Heathrow Airport next week. Strike action was scheduled for the 23rd and 24th. That has now been postponed to allow union members time to consider a new pay offer, but the Unite union still warn of a summer of travel chaos, with walkouts scheduled on a number of days during the peak season. So next week will be really interesting to see if workers do accept the pay offer or go ahead with strikes, which will target peak days for travelling from Britain's busiest airport.
Right, Simon, we'll look forward for a better week next week. Thank you and enjoy the rest of the weekend. And we'll take a break now. When we come back, we'll do a wrap-up of South African Market Week. Do stay with us.